Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Financial advisors have been including commodities in client portfolios for years, as it is a common investment strategy to help increase portfolio diversification. But there's one commodity that is often overlooked when one considers investing in commodities. Well, I am very excited about today's show as we have on a very special guest who is an industry expert in commodities and is going to talk about the commodity that is sometimes overlooked. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I'd like to give a very warm welcome to Tim Kramer. Tim is the CEO of CNIC Funds. Tim, thank you so much for coming on the show. It's such an honor to have you on. I really appreciate it. Can you please tell us a little bit more about yourself and CNIC Funds?
Sure. I'm Tim Kramer, and as you said, I'm the CEO of CNIC Funds. I originally got my start in the financial markets and in commodities back in the mid to late 90s. And I've worked for electricity companies. I've worked for what's called IPPs, independent power producers. I've worked for utilities. Most recently, before I started CNIC, I worked for a private equity company where I was responsible for hedging their commodity exposure for their private equity and their infrastructure group. So it would be interest rates, metals, FX, any kind of energy like, crude oil, natural gas, coal, whatever. And so we handled all of that. And while we were doing that, we kind of had an epiphany. And that was, there's the two prevalent commodity indexes out there. One is called the BCOM, the Bloomberg Commodity Index. And the second one is called the GSCI, the Goldman Sachs Commodity Index. And oddly enough, S&P owns it, not Goldman Sachs anymore. And so there's somewhere between 500 to 800 billion dollars that's tied to these commodity indexes. And what they hold is like 24 different commodity futures, like commodity futures for gold and corn and crude oil. So the reason we started scratching our heads is the most consumed commodity in the US on a retail notional basis is electricity. And electricity has an electricity futures market, just like all these other futures that are on the BCOM or the GSCI. And the electricity futures market is owned by ICE, the Intercontinental Exchange, same guys that own the New York Stock Exchange. So we're just kind of shaking our heads saying, wow, why is it that the most consumed commodity in the US isn't in any ETF or any index or any mutual fund or anything? And so we jokingly say, but kind of jokingly, I guess, like a long weekend in the case of beer, we came up with an electricity index based upon the electricity futures that ICE has. And then what we did is we partnered with ICE and we launched the index in January of 23. Okay. And then we launched the ETF benchmark to the index in May of 23. And the ticker for that is AMPD, AMPD. And the reason we chose that is because all the other cool ones like Volt and Shock or whatever were taken. So, and there's a whole side story in how people select tickers, which is kind of interesting, but we'll save that for later.
Yes.
But yeah, so we launched the index and then we launched the ETF, and that's kind of the background of how we set this whole thing up.
That is awesome. Great story. There, Tim. I love AMPed as a ticker, much better than Volt or anything like that. So, so I'm glad you did AMP. Real quickly, do you know why, or ever found out during your research why electricity isn't included in those primary commodity indexes?
Yeah, so the first commodity index was created back in like the 70s, okay. And the first. And it was a forerunner to, we'll say, the Goldman Sachs Commodity Index. But the first financial products tied to that weren't until like 1998. And so it takes a while to educate people and kind of get them comfortable with that. That's the first thing. The second reason, and you'll see I break things down into three because I can't remember more than three things. So there's the how long it took to adapt the initial commodity index is kind of number one. The second thing is electricity traded on a futures exchange really didn't pick up until like early to 2000 2005 time frame ish.
Okay.
And so it's still kind of new, and it took a while for people to get initiated into kind of what's going on there. And then the third reason would be we have tailwinds now that you just never had before. So as the U.S. goes towards what we've coined the phrase the electrification of America, and so you can't pick up the paper without reading about, we're trying to be renewable. We've got all this demand from data centers, and the list goes on. But that's kind of awakened people's just awareness of this. So when those three things kind of converged, like what we have now, we think that this is the opportunity. But before then, you just didn't have enough people paying attention to it, and it was still too new.
Very interesting. Yeah, until we started talking, I never realized electricity wasn't in those indexes. You just kind of assume that, it's a commodity like any other commodity, that it would be. So I'm really glad. It's very insightful.
Well, the other thing too, and is I'll pick on my parents because I don't think they're going to listen to the podcast. So I always use
You
mom
never
and
know,
pop.
Tim. You never know.
I always use mom and pa Kramer as like the default investor, right? And so if you talk to mom and pa Kramer, they understand what it's like to hold a bar of gold. So they kind of understand gold as a commodity. And they know that their car runs on gas, so they understand gasoline, et cetera. But for electricity, they hit the light switch and the lights come on, and that's kind of game set match. That's all they really know. And so I've probably explained to them a dozen times about electricity trading and what's going on, and it's just difficult for people to kind of understand how you can trade and or have a forwards and futures market for a commodity that can't be stored.
Interesting. And I don't want to go off the rails here, but that might be one reason why it's hard for people to grasp like Bitcoin or crypto, right? It's not tangible. You can't, there's no dividends, there's no valuation to it. The valuation is what you and I believe it is worth, unlike, pork bellies or corn,
Yeah.
like you said, right? Or coal.
Well, it's like I always like Bitcoin because, again, I actually started out trading currencies for Lehman Brothers back in the early '90s, and so I still pay attention to currencies. And I did a bunch of currency hedging for the private equity shop I work for. And so when I talk to my parents about Bitcoin, I'm like, well, where are these coins? It's like the coins. There are no physical coins. How can you have money with that? Dad, when's the last time you actually touched a dollar bill?
Yeah.
And he's like, so yeah, it's just you get people that are kind of set in their ways with exposure to certain things, and it's difficult to get the mindset changed.
Yeah.
And that's one of the things that we need to do in terms of getting people kind of indoctrinated to understanding electricity as a commodity that's a traded commodity.
Fantastic. Well, perfect. That's why the next 30 minutes or so is going to be so important. Talk about electricity. So let's start talking, electricity as an investment. You've talked about it. We've started talking about electricity as an investment on during the first 5 minutes. But what are some economic trends that are impacting electricity as an investment?
So in terms of, we'll say, just macro trends on this, we like to say that the demand is grossly understated, the supply is overstated, and then there's a reliability issue. So when we say that we think the demand is understated, if you take a look, and it's kind of in the papers everywhere now, but if you take a look at EVs and higher powered chips, data centers, AI, everything that goes on. We can cite lots of numbers for that, but you're seeing that the predictions originally, I think it was in 22, the original EVs used, I'm sorry, data centers and AI used about 2.5% of electricity in the US in 2022. And the prediction was by 2030 that they would use like 7%. Well, 2023, they used 5%. So like, wow, we doubled in a year, and they saw all the data centers are getting built. So now the predictions are by 2030 that the US electricity consumption just from data centers alone could be anywhere between 10 and 30%. So that's just one example of the robust growth. And then you talk about electric vehicles, and the internal guidelines are that by 2030, no state wants to be able to have any new cars sold being a combustion engine. And
Mhm.
so you take a look, and I'm not really sure that's achievable. I don't know. I'm not smart enough to know that, but I do know that probably there'll be a twist to the rules where hybrids might count, and so those things still get charged. So there's just a lot of demand as we go towards everything being electric. So that's kind of the first thing. The
Mhm.
second thing is then on the supply front, the US had a stated goal of being like 85% renewable generation by 2030 and 100% renewable by 2035. I think that 2035 guideline has kind of slipped a bit now,
Yeah.
but there's still, a big push to have all of our generation be carbon free. And so what happens is there's a backlog for getting these things through the actual, the paperwork, the development queue. So
Yeah.
there's a delay there, and then just kind of like the material and everything you need, like infrastructure wise. So the transmission lines and the upgrades that you need to get done to support the data centers and the new renewable generation. I believe I read a study that said the amount of copper that you need for this new build out is more than like the existing copper that's been mined in the history of the world. So there's all sorts of crazy little stats like that, but we think that basically you're retiring fossil generation at a rate faster than you're replacing it with the renewable generation. And so we think there's a supply issue. And then the reliability issue. When you talk about fossil generation, which is getting retired, most of
Mhm.
that, for the most part, is what's called dispatchable. So you can vary the output of that. So if you have an increase in temporary demand or an uptick in weather, you can vary the output to meet that. But with renewables, you either get the sun and the wind or you
Yeah.
don't get it. And so there's not enough battery storage right now. I think battery storage is like somewhere between 2 and 5% of the total grid. So there's not really enough battery storage right now to buffer all that. So matter of fact, there was an article in the Wall Street Journal today that talked about the increased interest in batteries. And in the article, they talk about one thing is for sure, volatility is going to increase. So
Mhm.
from a long-term macro viewpoint, again, we think demand is understated, supply is overstated, and the reliability is going to be an issue.
Interesting. So you talked about, in terms of the demand, you have AI and these huge data centers, which are only going to grow. And we also talked about Bitcoin. Bitcoin is also one of those items that draws a lot of electricity to mine Bitcoin. So I'm
Right.
assuming that's another item there too.
Right. So from what we've seen is about 85% of the operating expenditures of mining Bitcoin is electricity. And it looks, from what we've seen, those guys are pretty good at keeping their numbers where they need to be in terms of quiet or veiled. But it looks to be that for every Bitcoin that you mine, I think that they spend, we'll say, I believe it's like $17,500 in electricity, and Bitcoin's trading 64,000 today. So they can afford to
Mhm.
spend more as they continue to mine this, but it is a big impact, yes.
Interesting. So yeah, based on what, the way the macro drivers are, you think the price of electricity will go up or, because of that demand and supply not, potentially meeting the demand. So let's talk about portfolio construction. As our, financial advisors are listening, what benefit does electricity bring to portfolio construction?
Sure. So when we talk about portfolio construction, there's usually two reasons why people put something in their portfolio. And the first is strategic, which is why do you buy it and hold it forever? The
Mhm.
second reason is tactical, which is why do you buy it now? So in terms of the strategic, why do you buy and hold it forever? The 60/40 portfolio, and again, picking on Ma and Pa Kramer, the 60/40 portfolio that they've been preached to for so long that this is what you need, that's starting to fall a bit out of favor, like you said
Yeah.
at the beginning. And so 60/35/5 is what people are looking at now. And if you go back to like, I believe the time frame was like January of 2018, and you take a look at the 60/35/5 on an absolute return basis and on a risk adjusted basis, the 60/35/5 beats the 60/40. If you take a look at 60/35/3 2, with three being the commodities and two being us, electricity, it beats everything on an absolute return and a risk adjusted basis. So we're not saying that you should put 30% of your portfolio on electricity. We're saying you should put in a number that's a certain amount and hold it long term. So the first thing of portfolio construction is the model portfolio. The second would be inflation protection. So if you look at CPI, hardwired in terms of weight, 2.5% of CPI month in and month out is electricity. That's the direct. The indirect, we think electricity touches darn near everything. And so the example we use is, the retail grocery store. About 85% of their operating expenditure is electricity, and their profit margins are like 1%. So if you have an increase in electricity prices, what's that going to do to food prices? I mean, obviously it's got to increase. So we think that there's, the 2.5% definitely hardwired, and then we think that the indirect is almost the other remaining, 98%.
Yeah.
So we think from an inflation perspective also, and there's a high correlation between electricity and CPI. So we think the second reason you put in your portfolio is inflation protection. And then the third is portfolio diversification, which is, we are not correlated to any stocks, any debt, anything like that. So it gives you that aspect of it. So that's the strategic. The tactical is like, why do you buy it now? And we just take a look at, like we've already talked about, the supply demand piece of it, number one. And then number two, when you buy electricity futures, which is what the ETF consists of, is these electricity futures. If you buy $100 worth of electricity futures, $15 of that goes into your broker account to actually support the futures you're buying.
Yep.
And then the other $85, they go into 3-month treasuries. So you, in essence, get paid the risk-free rate to hold this position while you wait for those fundamentals to kick in. So we think from a portfolio perspective, 30%, no, 2-3% kind of correspond to CPI and give you the right commodity allocation. That seems to be, on a mathematical basis, looking at the index, that kind of seems to be the right number.
Interesting. Let's go back. You threw out a bunch of great information there, Tim. The buy and hold strategy. That's how financial advisors should look at it, right? Long term, not something you're moving quickly in and out, trying to time it. It's got to be a long-term investment.
Yeah, we designed this to give you exposure to electricity as an asset class. And so, there may be some individuals that take a look at this that are sophisticated and say, oh, I've got some arbitrage I can do based on seasonality or correlation to, other energy classes, whatever they want to do. That's great. But we really think that from an investment perspective, that it belongs in like pensions and endowments, right? So when you talk about endowments, I believe the top 100 endowments have, I'm not sure the number, it's like 100, 200 billion, whatever the number is. It's a big number. And then with pensions, that number is in the trillions of dollars for what they have. The endowments tend to run about 2.8% of their AUM allocated to commodities, and the pensions are a bit less, around 2.3%. And so we're just saying that the commodity allocation to those portfolios, since they've already got that, a portion of that should be electricity. So again, if you're an endowment and you've got 3% allocated to commodities, we're not saying all 3% should be electricity. We're just saying a small portion of your 3% should be here, almost like what some people call smart beta.
Interesting. I've done a lot of research using Zephyr about the impact of commodities and alternatives to portfolios, and obviously it moves the efficient frontier and those optimized portfolios to the northwest, which you want to see. And recently, you talked about the 60-40 portfolio, and it's been under scrutiny. It did not work during the pandemic as correlations increased. And you talked about diversification. It's during those time periods, that diversification, those alternatives really help. So I can understand why including electricity has a great benefit during times of uncertainty and higher correlations.
Yeah, and that's again kind of one of the benefits that we're looking for on this. Absolutely.
And you brought up inflation. We can't, bring up inflation, or it's the topic. Even though inflation is cool, prices have come down, it's still headline news all over the place. And you talked about the impact electricity has on inflation. So let's talk about the Fed. What role does electricity have on monetary policy? And with that being said, do you think, and based on your views on electricity moving forward, the impact it has on inflation, do you think it will impact upcoming interest rate decision making by the Fed?
So I do, but I'm probably the only person on the planet that thinks that. And so if you go back and you look at Fed speak, Powell speak, et cetera, you're never going to find anything where they're talking about, electricity prices and
Mhm.
weighing into their decisions anywhere. And that's fine. I get it. But some of the things that, just like we talked about in terms of inflation, if you just take a look at the CPI and you take a look at where forward electricity prices are, and you kind of just map that onto what's the impact going to be on CPI in the upcoming quarters, it looks like the impact of electricity is already going to have you above the 2% CPI number that the Fed targets. So if electricity alone puts you there, then the other elements themselves, with their weights as they go there, I think it makes a difficult environment for them to cut. But again, they're not mapping to electricity; they're mapping to a lot of other things.
Yeah.
Some other corollaries, and I'm sure you've got people that can speak a lot more intelligently than I can on this, and guys are going to throw rocks at me left and right.
Yeah.
But if you take a look back historically, you'll see, Fed speak, Powell speak, whatever. They'll give little indicators of what they think they're looking at for kind of their metrics and their
Yep.
triggers. But one of the things I thought was interesting was they talk about the basically the shape of the curve between the 1 month and the 12 month. And so if you look back historically and you look when the Fed cut historically and
Mhm.
you look at what that difference was, so the 1 month less the 12 month, what range that's been in, it's been anywhere from like 15 bips 1 month over to like as much as like I think like 40 bips when they've been doing their
Yeah.
cuts. The beginning of the year, you were up around like 65 bips, I think, and they didn't cut. And so you've been, for the past 6 months, you've been above the range where they typically cut rates, and they haven't cut rates. So this is probably, anecdotal evidence, or you could look up something else. I don't think the Fed's looking at my electricity index or anything else and saying, oh no, we can't cut. But it is interesting that their triggers have been met and exceeded, and they haven't done it. So that's just kind of a head scratcher there. And I would say this: if you look like right now, nationally, from the data that we've seen, about 19-20% of the general public is behind on their electricity bills, and behind by like a significant amount. So just not quite sure how this all plays out, but I do think it adds to the backdrop of, if I'm king for a day, I think it makes it more difficult to cut rates than it would be if you weren't looking at this, pressure on electricity prices.
It's really interesting. A great viewpoint there, Tim. Like they are in a tough position, the Fed. Markets right now, small caps have been raging recently, and I think a lot of that is because they're so rate sensitive. Markets are thinking the Fed's going to cut, inflation's come down, and as a result, small caps are pricing that in. But like you said, there are other things out there that say, hey, wait a second, take a step back. Like you said, that was very interesting about the shape of the front end of the yield curve. Doesn't really indicate that maybe the Fed should cut. Maybe they should wait a little bit. Very interesting. And then, you know, it's just ever since the pandemic, I often talk about, maybe 2024 is a year of normalization. We're going to get back to being normalized since the pandemic. I haven't really seen it, right?
Yeah.
It still isn't normal, or whatever normal is. Do we
Yeah.
know
And
what normal is? So,
no, and to be clear, I'm not a Fed expert. I'm
yeah.
not an interest rate expert. And yeah, I guess it was Ben Franklin that said success has 1,000 fathers and failures but an orphan. So if it turns out there's something to what I'm saying, I'm sure people a lot smarter than me are going to zoom in and take credit and run with the ball. And if I'm wrong, they'll throw rocks at me for a couple of days and then forget me. So that's fine.
Yeah.
But I do think, to your point, it's interesting because you can kind of look at the probability, looking at the Fed fund futures or looking at the SOFR futures, and you can kind of look at the shape of those futures curves, and you can kind of divine what they're saying for the probability of the cut, then the timing of the cuts. And if you look at the beginning of the year, what the shape of the SOFR curve was, 3 month SOFR, versus where the 3 month SOFR curve is now, it looks like the general, market making public has decided to reduce the severity of the cuts and kind of push out the tenor of the cuts a little bit
Mhm.
too. So not quite as aggressive and not quite as robust as what people were thinking at the beginning of the year. So we are seeing some mitigation.
Yeah.
Um, Again, I like drawing the corollaries to electricity, and I'm probably the only guy on the planet that does that.
I love it. I love it. First time I've heard of it, and I love these different viewpoints and thoughts. So, the Fed, is there any correlation between interest rates and electricity? So, let's say the Fed does cut. How does that impact prices of electricity? Is there any impact or correlation? Does the price or usage go up, or is there any impact between rates and electricity?
So interesting question. We plotted the index, the power index. It goes back to, like we said, 2014. And ICE is the index calculation agent and administrator. And so we plotted that against Fed funds, and you can see if you do the correlation of it, the correlation isn't actually that strong between the Fed funds rate and what electricity is. But that's because you're looking at monthly data on the Fed funds, and it just the granularity just doesn't make a good comparison. But just the eyeball test on the graph, when you see the electricity index go down for a period of time, you see the Fed cutting. And then when you see the electricity index go up for a period of time, you'll see the Fed raising. And that's, the electricity index probably leads it by maybe, we'll say 3 to 6 months. And so I can't mathematically prove it. I can look at it and say, that sure looks like there's something there, though. And then in terms of trying to connect the dots, I'd be trying to connect the dots on something that I eyeballed versus something that I had the math on.
Yeah.
But I would just go back to the fact that electricity, we're more and more electricity dependent rather than less. And so I do think that there is going to be a stronger mathematical relationship and a stronger fundamentally linked relationship between those two things on a go forward basis.
Yeah. Interesting. The story for electricity seems very attractive. When we started this conversation about the macro drivers, supply and demand, there's more demand, and moving forward, likely more demand than supply. A big opportunity there in terms of investing. The benefits to portfolios, increased diversification, a hedge to alternative or inflation. A lot of benefits here to including electricity, and the fact that electricity is not included in commodity indexes. So how can financial advisors and investors gain exposure to electricity?
So there's actually only one way to get exposure to electricity futures as an investable asset class. And that is with the ETF that we have, which is amped, because we've got a 5-year exclusive with ICE on the data and the index. We're the only guys that can do this for 5 years. And so, I think it would merit for the reasons that we talked about. It's interesting, and it gives people an opportunity to show something to their clients that they maybe didn't see before.
Fantastic. Great, Tim. Thank you so much for coming on the show. It really was such an honor to have you on. Very fun conversation. I hate to say it, I don't really think of electricity very often when I'm doing research and building a portfolio. So very enlightening. I love it.
I'm sure you'll have a lot of people that want to come on your show now and throw rocks at me over the link to the Fed cutting or not cutting and interest rates. So if nothing else, it'll be a good lightning rod for you to get some other stimulating conversations going.
There we go. We always like that little contrarian view, right? And then Tim, when the Fed doesn't cut and they push it off to 2025, we can post that segment all over, and it's like Tim Kramer called it.
Now, I'm sure somebody else that's better at math and cracking the code on that will come up and have some more detailed analysis, and that guy can run with the ball, and that's great. But I do think it is an interesting topic, like you said, and there's just some dynamics here that you kind of got to scratch your head. I'm not sure how they play out.
Yeah, it will be. It'll be fun to watch.
Yep.
Like you said, I've watched the Fed and listened to it. I'm not an expert. But I mean, you have to in this industry, you have to pay attention to what the Fed. But with that being said, I've had a lot of guests on. We'll talk about the Fed, and they'll say markets, there's too much weight given to the Fed and their statements. It's kind of interesting how they, even in Fed watchers, they're like, we pay too much attention to the Fed, and we, focus too much on what they say, and they have too much weight.
Oh yeah, I mean, that's exactly what we did when we went back. We went and looked at like all of the different press releases to try to see, okay, what are the three triggers that they tend to look at when they make rate decisions? And it just depends. When you look, you got a collection of 503 triggers that make up the three triggers that they may look at.
Yeah.
They'll mention different things at different times. And so we just tried to say, okay, if you wanted to take the noise out of the equation, like what one thing could we quantify and compare that quantification to the cuts? And that's why we looked at, and I believe it wasn't that recent. I think it was like 2022 where Powell talked about the shape of the curve in terms of the short versus the 12-month. And so that was kind of like the only thing where it's like, okay, take emotion out of it and just, take subjectivity out of it and just objectively, can we look and see if this is his trigger? What did it look like historically? And then, we've already violated the trigger now. So maybe that's just not the right indicator to look at. I don't know.
Yeah, fantastic. Again, thank you so much, Tim, for the fascinating conversation. Where can our listeners get more information about CNIC Funds?
Sure. You can go under our website, CNIC Funds, funds with an S.com. So just CNICfunds.com. And it has, we try to publish white papers on there.
Okay.
We've got information, prospectuses, things about the ETF. And so, hopefully if this is interesting to someone, they can do some more research and see if it fits them.
Yeah, you guys have some fantastic research and thought leadership leading up to this call. I went there and read some of your content. It's really enlightening, great stuff.
Appreciate it.
Tim, thank you so much for coming on the show. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.
Thanks for having me.
Tim.